Welcome to the deep dive. Today, our mission is to decode this current Bitcoin liquidity trap using the latest market reports.
Right, and since you tuning in probably already know how this space operates, we're skipping the crypto basics today.
Exactly, yeah. We are jumping straight into the complex dynamics that are, dragging the market down. I mean, think of the current market like a leaky bucket.
A leaky bucket, yeah, that's a good analogy.
Like, offshore buyers keep trying to fill it by buying these intraday dips, but U.S. institutions are just systematically draining it from the bottom.
They really are. I mean, we just saw this play out in real time.
Right. Bitcoin opened at $63,000, but then algorithmic selling in the 24/7 Asian markets immediately drove it down to a low of 62,220. So what is actually causing this invisible puncture?
Well, for the mechanics behind that leak, you have to look at the Coinbase Premium Index. We literally just hit a 77-day negative streak.
Wow, 77 days.
Yeah, it's at negative 0.1369%. It's definitive proof of domestic institutional de-risking. Basically, the price on Coinbase is consistently lower than on global exchanges.
Which acts as the proxy for U.S. institutional activity, right?
Exactly.
Yeah.
They use these TWAP, or time-weighted average price algorithms, to slice massive sell orders into tiny pieces.
Right, instead of just crashing the market all at once.
Yeah, it acts like a stealth drain on the price whenever there is even a bit of strength.
But wait, that doesn't completely make sense to me. Like, why would multi-asset managers be fleeing Bitcoin right now?
Well, it's a combination of...
Because, last week, U.S. spot Bitcoin ETFs saw over $61 million in outflows. But at the exact same time, spot Ethereum ETFs saw $27 million flowing in.
Right, yeah.
If this is a general pullback, why the sudden pivot to Ethereum?
It mostly comes down to utility and yield.
Yeah.
I mean, in a high interest rate environment, capital naturally rotates.
Okay, so fiduciary allocators are just moving away from non-yielding assets.
Exactly. They're shifting toward networks with decentralized finance utility that actually generate yield. But, it's not just fund managers pivoting.
Right, the corporate liquidations.
Yeah, massive corporate treasuries are capitulating under pressure right now.
But the logic seems flawed there, too, honestly. Like, Strategy Inc. recently sold over 1,600 Bitcoin at a loss.
A pretty huge loss, actually.
Right. They realized $63,957 per coin, but their historical purchase price was over $75,000. Like, why do that?
Well, because they had to fund dividend obligations. When operational cash flow dries up, these companies are forced to liquidate pristine collateral.
Just regardless of the spot price.
Exactly. And Trump Media did something similar. They just transferred over 2,600 Bitcoin to crypto.com.
Wait, really? That is a massive chunk.
Yeah, they have now liquidated 63% of their original reserve just to maintain operational solvency.
Okay, so we have this voluntary, albeit painful, corporate selling. But how does that connect to the sudden structural failures we're seeing?
Well,
Like, it feels like we're watching isolated technical and macro events combine into a perfect storm against Bitcoin's price floor.
they absolutely are combining. And the mechanism connecting them is panic.
Right.
Take the Coldcard hardware wallet exploit, for instance.
Oh, man. Yeah, that was catastrophic.
It really was. Hackers found a flaw in how the wallets generate the initial random private key and stole over $100 million.
Which triggered immediate panic.
Right, because a firmware patch cannot retroactively fix a compromised Genesis key.
And we saw the on-chain reaction right away. I mean, there were nearly 39,600 Bitcoin in panicked sub-1 Bitcoin transfers.
Yeah, it was the highest since the FTX collapse. People were just frantically sweeping their funds.
And while crypto infrastructure is failing on one end, traditional macro forces are squeezing global liquidity on the other, right?
It's exactly. The U.S. and Japan's joint yen buying operation is draining global dollar liquidity. It forces an unwind of the yen carry trade.
So as the yen suddenly strengthens, investors have to sell off global assets, including Bitcoin?
Spot on. They have to cover those increasingly expensive loans. And that contagion is spreading. And AI hedge funds collapse actually dragged the Korea 200 index down 5%.
Which I'm guessing just triggers algorithmic risk engines to step in and blindly sell liquid assets to meet margin calls.
Exactly. Cross-portfolio margin calls force selling regardless of the asset's underlying value.
So we have this barrage of forced selling colliding with a completely paralyzed regulatory environment in the U.S.,
Yeah, the Clarity Act is totally stalled out.
which guarantees we are stuck with ambiguous regulation by enforcement. So for you listening, the key metric to watch next is the Federal Reserve's M2 money supply data.
Because Bitcoin really needs that expansion of fiat liquidity to sustain any real price appreciation.
Exactly. Which brings us full circle to that leaky bucket. But here's the final question for you to ponder today. If decentralized hardware wallets are failing at the architectural level and regulatory clarity is basically dead in the water, are we inevitably being herded into relying on centralized institutional custody for our digital assets?